Hi everyone, my name is Yash, and on this channel we're going to talk about real estate and business in India. So if you're looking for the absolute basics of real estate, I did a podcast with my friend Ranveer from Beer Biceps. I suggest you check that out. I'll be putting the link in the description. A huge thank you to each and every person who reached out to me, asked me questions, researching to answer those questions, gave me the idea that I should address them through a video, and that's what we'll be doing today. Since a lot of people ask me about passive income and real estate, I thought that it would be a good time to make a video about it. Now, the reason I'm making a comparison with fixed deposits is that FDs are the first thing we learn about in India when talking about growing your wealth or passive income. And why shouldn't they be? They have low risk, they have regular payouts, and it makes sense to a lot of us to start investing through fixed deposits. And I know that investing in real estate may not be as straightforward as opening up an FD in a bank, which is why today I want to talk about real estate investment trusts or REITs as an easy way to start investing in real estate. So the two questions we're going to be covering today are: why are REITs a good way to start investing in real estate, and why REITs could be a better alternative to FDs for you. So let's go over what a REIT or a real estate investment trust is. A REIT is basically a portfolio of assets managed by an independent trust that's listed on a stock exchange. From renting these properties out, to contracts, to maintenance, to even expanding the portfolio, this independent trust handles all the aspects of the business. So currently in India, all the listed REITs and even one of the upcoming ones contain commercial office properties that have rent-paying tenants. As mandated by SEBI, these trusts are required to pay out a vast majority of these rents to unit holders or shareholders as dividends. So why are REITs a good way to start investing in real estate? Let's break it down. Firstly, the ticket size. If you go to purchase a commercial rent-earning property, a pre-leased property, in any of the metros or tier 2 cities today, you're going to be setting yourself back by lakhs or crores of rupees. And that doesn't even count the potential liability you take on along with an interest burden if you're taking a loan to buy these properties. In comparison, the minimum amount of units you need to purchase in a REIT comes up to around 50,000 rupees as per the prices today. So for just 50,000 rupees, you're getting access to some of the best commercial properties. Which brings us to our next point: asset quality. These REITs contain the best office parks from the best locations all across India, rented out on long leases to large MNCs and blue chip tenants. If you go out in the market today, you may not even be able to purchase a property like this one. REITs are also very efficient because they give you all the benefits of owning a rented property without any of the day-to-day management or costs associated with being a property owner, like property tax, registration for new agreements, brokerage. This bypasses all of that. As compared to owning a single property, the portfolios in these REITs are diversified. They're all backed by a finished product, since these REITs are only allowed to put a very small amount of their earnings and portfolio into under construction projects. REITs are also great at providing regular income. By law, these REITs have to pay out over 90% of their earnings as shareholder dividends. Now, this dividend is based on the listing price and not the market price, so the yield can vary. But given the performance of the REITs in the last year, returns are predicted to be around 7% for dividends. Since they're listed on the stock market, REITs are also way more liquid than an actual commercial property. If I want to sell a property today, it may take me weeks before I'm able to market it, find a client, complete the registration. In comparison, selling a REIT is like selling any other stock. You just do it through your Demat account. Now, let's compare REITs to fixed deposits and see how REITs could be a better option for you. Firstly, let's talk about the tenure. With any fixed deposit, you have a fixed term for which you agree to keep this money with the bank. If you break your FD before this term, you will have to pay some sort of fees. In comparison, because REITs are so much more liquid given that they're listed, you don't have any fixed tenure and cashing out is completely your choice. So let's talk about the returns. Now, the highest FD return rate in India is around 7%, that too with banks that aren't exactly very stable. The largest private sector banks usually offer an FD rate of about 5%. that too for a year-long tenure. So these rates are made to encourage longer investments and keep you locked in. In comparison, the REITs listed on the market today have dividend rates of about 7%, and while that yield may change depending on the stock price, it's still far higher than most of the FD options available to you that have a tenure of a year and under. Now let's come to one of the most important distinctions between REITs and FDs, the tax implication. The interest income you earn of a fixed deposit is taxable depending on the income tax slab you fall in. Whereas with REITs, you don't have to pay any dividend distribution tax as a unit holder. Further, if the stock price goes up and you decide to cash in, all you have to pay is capital gains tax, and this makes a big difference in terms of tax efficiency. Okay, so let's break this down with an example. The Embassy Office Parks REIT, the first REIT to get listed in India, went onto the market about a year ago at an IPO price of Rs 300. Over the last year, the dividend payout per unit has been about 24.3 rupees, which gives a yield of about 8%. On top of this, the stock is trading at 350 rupees today, up from the IPO price of Rs 300. This gives you an appreciation return of 16.7%. If you add this to the dividend you get a return of about 24.7%. To wrap things up, I know that I've compared a debt product to an equity one in REITs, but I feel like the nature of the underlying assets mitigates the risks with REITs a bit. You get locked in tenants with strong long-term contracts and an expanding real estate portfolio of AAA properties. As compared to buying a commercial property, once you purchase the REIT, you don't have to get involved in any day-to-day work. And for a starting price of Rs 50,000, I think this is a great way to get started on your real estate investment journey without getting involved in the day-to-day work yourself. All right, everyone, thank you so much for listening. And please give me any feedback that you have in the comments and let me know what kind of other real estate or business topics you would like me to break down in future videos. Thank you.